looks like we're going to be slightly lower, certainly at the opening bell, but you never know how we'll look at the close. Nasdaq down almost exactly 100. That would be 8 minutes before the market opens. Let's bring in Ed Siddell. He's our market watcher of the morning. Ed, now let me give a big picture here. For maybe 20, 25 years, we've been told that a debt crisis is coming. It's just round the corner. The debt bomb is going to explode because we're borrowing too much and the debt's too high. You think the debt crisis is almost here, don't you?
Yeah, well, I don't know if it's going to be in the next 5 months or the next 5 years, but even Moody's, I mean, they're starting to downgrade banks, and even the larger banks, they're put on the watch list. And there's so much consumer debt. I mean, from a national debt level, we're spending $5.1 billion more than what we're bringing in tax revenue. So, and this is all inflationary, which is going to increase rates to get inflation under control, create more downward pressure on banks across the board. And, eventually, the chickens are going to come home to roost.
I'm not asking for a time frame, but we are moving up the debt crisis, aren't we?
Yes.
And when you couple it with today's slightly hotter than expected inflation number at the producer level, this seems to be a significant overhang for the entire market.
It is. And I don't know if the markets have actually priced in, another rate hike. I think we're definitely going to see one in September. And I wouldn't be surprised if we see, one or two more. Because inflation is here to stay. And it really has more to do with we cannot get spending under control. Again, the only tool in the tool bag that the feds are using right now is interest rate control. And so that creates more pressure on American families, which is increasing credit card debt. And it hit an all-time high. So, again, everything is kind of coming to the surface. I don't know if we've hit that tipping point yet, but we're pretty close.
Should I put fresh money into the market now? If for some reason I liberate some capital, I've got some money on the side here, should I put it into stocks now or a 5% one-year treasury?
Honestly, I like the one-year treasury. We're still in the market. There's a couple sectors that we still like, but in the majority of our portfolios across the board, I like the one-year T-note because it's that risk-off investment.
You say you like a couple of areas. What are they?
Yeah, I like utilities. I really like energy and healthcare. Those three things right now, again, especially going into winter, they're pretty stable. So, and again, we're hedging our bets. I also like a little bit of precious metals right now to hedge against inflation in the U.S. dollar, because I think that's in danger as well. But again, that should just be a very small portion of the overall portfolio.
We've had lots of discussion recently about gold. Not much on this program, but in Wall Street generally, I see gold looked at frequently. What proportion of your assets should be in gold? And what kind of gold? Gold bullion, gold coins, gold mining shares, what?
I think it should be, if you're investing in the market, it should be between the mining shares and the gold stocks. But I like legal tender. If you're going to physically hold it, I like legal tender. And it doesn't matter if it's, from the U.S. or Krugerrands or wherever it is, but legal tender, I think, is really important. And, again, it's not so much an investment as it is a storage of value.
Exactly.
So that's really what you have to look at, especially as if we believe inflation is going to continue to grow, and it will if we keep spending, I think it's a great place to store value.
Yes, and you can also bury your gold and keep it away from prying eyes, can't you? That's always a nice thing to have going for it. Ed Siddell, thank you very much for being with us this Friday morning. We appreciate it, sir. We'll see you again soon. Okay.
Thank you.